In this next example, we'll be looking at problem 12 in chapter 14. Here we have an NPV analysis where you would like to invest in a company. The initial cost is going to be $150,000, which will be paid over the next 5 years in equal installments. The company will generate some annual revenue, which is expected to be around $100,000. The cost percentage is around 65% of the revenues. There is a 36% tax rate. The discount rate we'll use for the NPV analysis is 5 years. We'd like to look at whether this is a viable investment or not. So let's first look at the base case I created. In the base case I created, I have my annual investment, which is the total investment divided by the time horizon. The revenues are $100,000 each year. The costs are the revenues times the cost percentage. The profit is revenue minus cost. Taxable income is profit minus your investment. And the tax is taxable income times the tax rate. And then the cash flow is your profit minus your investment and minus your tax. And based on our cash flow in every year, we can calculate the NPV of this model. For the base case, as you can see, we have a positive NPV value. What we would like to do is add uncertainty to this model. It's been shown that annual revenues will have a triangular distribution. The operating costs could be anywhere between 55 to 75%, which means we need to use uniform distribution. The tax rate is going to be either 40% or 36%, depending on factors that are outside your control. And even in the cases where your taxable income is negative, you will still have to pay tax because you will have probably other income, so the tax effects will still hold. Now, in order to create a simulation model here, first I have the simulation template. Let's see what I have changed. As you can see, the annual investment is not uncertain, so that's the same. The revenues now will be triangular distribution using these three parameters. The cost percentage will be uniform distribution. The tax rate is going to be custom discrete distribution. And I also need to make sure that I add the NPV, and I also want to look at whether the cash flow is going to be positive in each year. Now, if you look at the problem, part C asks, what is the probability that the cash flow will be positive in all 5 years? So for that, I'm creating a new cell which says, look at whether the cash flow is positive in all 5 years or not. If it's true, then give me a 1, otherwise give me a 0. Now that I have the template, let's look at what my simulation model looks like. I have my revenues, which are the triangular distribution. I have my cost percentage, which is the uniform distribution. My tax rate is the discrete custom model. So I have all my three parameters defined now. If I look at my NPV, I have added the PSI output next to it. And if I look at my positive cash flow in full 5 years, I also have the PSI output here. Now I'm ready to run the model. So let's go to Solver platform, simulate, and click on run once. Now here you get to see what values are generated for each of the different parameters. We can get out of this. If you want to see the histogram of the NPV formula and the positive cash flow formula, you can go to model, you go to uncertain functions, you go to simulation, and you can double click on C25 which shows you that your expected NPV is positive, which is good. And then let's look at how likely we are to get a negative NPV. So I'm going to do a lower cutoff of 0. It shows me that there is an 83% chance that the NPV is going to be positive, which is a fairly good model. Now let's look at the cash flow, positive cash flow variable. As you can see, I get a 0 or 1. The chance that it's going to be 1 is less than 10%, it seems. The chance that it's going to be 0 is more than 80%, 90%. Let's actually look at the actual value. Put 0 here. I get that there is a 10% chance or maybe 11% chance that I will have positive cash flow each year, and more likely some years I'll have negative cash flow. So that concludes our analysis of problem 12.